Hey, what's going on, guys? This is your boy Deepo Adesina, and today I want to talk to you about why you need to stop saving money in the bank. That's right, you need to stop saving in the bank right now. As a matter of fact, if you're currently saving money in the bank, you are a loser. That's right. Well, no, you're technically speaking, you are not a loser, but your money is losing value in the bank. And I'm going to share with you some simple math that by the time I'm done, you're going to see why wealthy people and people who are wise with money don't rely on their savings account or money in the bank to help them determine their net worth, right? And this strategy is actually going to be good for someone who's looking to start thinking about their future, growing their wealth and being able to retire at some point. So I want to give you a very simple mathematical scenario that you can probably relate to. So let's say that you are a good saver. All right, you've consistently been saving money every single month. And let me say this, if you've cultivated the habit of saving money, you have mastered one of the most important habits that wealthy people have cultivated, right? Putting away a portion of your income every time you earn some type of, income, okay? Now, let's say you are 30 years old right now. So we're gonna put 30 years right here, right? So age, you are 30, all right? And then you have just cultivated the habit of putting away roughly about $350 every month. That's a cup of coffee every day to some people, okay? So we're looking at dollar amount and you're looking at $350 every month. All right, now remember, the bank's interest rate, the maximum that they're paying right now, at least that I've seen, is 0.05%. So we're gonna assume that your money is generating interest, right? Interest of 0.05% annually. And this is compound, by the way, right? You do it every year and you continue to generate, compound interest. Now, let's say you do this consistently every day for the next 30 years. So you're 30 years old now and you do it until you're 60 years old, okay? So by the time you're 60, you would have personally put in about $126,000, all right? You would have put in $136,000 30 years later. You would have put in $126,000. Now, if you now say, what is 0.05% compounding over a period of 30 years? My friends, you will have a total of a little over $127,000 plus, which means that your savings account, your good habit of saving money every month has only yielded you $127,000. Now, I don't know about you, but that's not a lot of money for me. In fact, that's peanuts. That's chicken change for a 30 years worth of savings, okay? And that's what most people are doing, relying on it. They're saving their way into the future. Trust me when I tell you, in the generation we're in right now, savings will not get you far. But now let me introduce you to another concept, right? Where you can take the same 350 and put it into what I call Index Universal Life, all right? So Index Universal Life is a type of insurance policy that grows based on the interest tied to the performance of the market, like S&P 500, all right? So the cash value of this policy is actually tied to an index. Now, the good thing is that if the market is going up, your cash value is also increasing. But let's say you have a crash in the market, for example. Well, here's the good news. Your money is actually safe. It's not impacted by what's going on in the market, right? It's the type of insurance policy that kind of protects your money from that, right? So now what's the scenario? So you're still age 30 and you purchase, let's say, $350 will get you maybe about $600,000 worth of life insurance policy, okay? That's the death benefit. So you have, $600,000 in, death benefit, all right? DB, death benefit, and you're putting away $350 every month towards this death benefit, okay? All right, remember, when you do this in this type of policy, a portion of that goes into the death benefit and a portion goes into the cash value. I think it's about 1/3 that goes into the cash value and then 2/3 goes into the death benefit. Now, in this type of policy, the interest rate ranges from 3 to 7% annually. And, like I said, because it's tied to this type of index, sometimes it's a little bit higher and sometimes it's a little bit lower. But generally speaking, this is what you're going to be seeing on an annual basis. All right. Now, take into consideration that 30 years later, you're still putting in roughly $126,000, just like you are in a typical savings account. But here's the catch. In 30 years, if you do this, here's what you're looking at. You're looking at roughly $240,000 plus. That's more than $240,000. Same amount in your savings account goes into Index Universal Life. But now here's the catch. Remember, it's a two-edged sword. You still have your death benefit, and at the same time, you still have your cash value. This is liquid cash that you can pull out from your cash value tax-free, right? Remember, you've already paid taxes on the money that's going into the policy, and you still have your death benefit. So when I tell you that putting money into your savings account as a strategy to secure your future, or most people would say a rainy day in case of emergency. Well, if you save for emergency, guess what's going to happen? One day you'll get that emergency. But you got to have a strategy for your money. And when you're looking at how to maximize your money, then you got to look at different avenues to grow your money. All right. I'm not a, I don't knock people who save money in a bank because that's all they know. But when you know better, you do better. All right. And that's why I strongly recommend to people, especially if you don't know anything about insurance policy and how they work, and you've been sold on the fact that it's only good for people after they're gone. Well, I just gave you a simple scenario, right? Like, let's assume that you're not even thinking about the death benefit, which this alone is just a bonus in itself. In fact, this is the main reason why you're getting a policy, but the bonus aspect is this right here. Okay. Now, I only did it for $350 on a monthly basis. What if you did more? All right. What if you do less? If you do less, of course, you see a lower number, but it's a lot better than this. And if you do more than $350, of course, you can see a significant increase in that. And I'll tell you right now, I know people, right, whose premium is a lot higher than this. And guess what? Their cash value is also higher. Okay. So, ladies and gentlemen, I'm sharing this with you not as a means to, get you to stop saving. Continue to save money because it's a great habit to cultivate. In fact, you are one step closer to becoming wealthier, more financially free, because you are doing what most people can't afford to do, and that's savings. But what I'm sharing with you is a better strategy to make your money grow. I hope you've learned something new. Thank you so much for watching this video, and I look forward to catching you in my next video. Until next time, peace.